would like to welcome and thank you all for joining us today for today's webinar. Welcome the clients who are returning clients and those who are attending for the first time. I'd like to thank all attendees who provided such positive feedback from the last webinar, and the suggestions that were provided have really helped to shape the content for today's presentation. I would be amiss of me not to mention the budget. Obviously, it was a very comprehensive budget with a lot of benefits handed out to many people. I'm not going to go into those in this presentation. However, I will highlight that there is a number of reference materials that have been placed on the website. We've sent out 2 emails with links to those, and there'll be the final email being sent out tomorrow with budget information. Obviously, it will have an impact for a number of people, so please don't hesitate to give us a call, or otherwise we'll be discussing how you are impacted in our regular review program. We incorporated into the last webinar some polling questions to encourage some debate and engagement, and also gives you an idea what other people are thinking. And I'll just ask Zita now to put up the first polling question, which just seeks to get your thoughts on the federal budget. So to what extent are you confident about the federal budget that was brought down earlier this week? And if you select one of those options, thanks, Zita. We might close that off now. And if you'd like to display the results. Okay, all right, that's interesting. Okay, thanks very much for that. We can close that. All right. In recent weeks, I've received a number of requests and inquiries about specific investments, such as gold, the Tesla stock, and a number of others. And today we have a fantastic presentation, because not only will you hear about how to gain exposure to specialised sectors, you will also receive information about the market outlook from a highly qualified presenter. At the last webinar in September, I explained why I was more confident in the market outlook for the next 2 years than I had been in the last couple of months, and that I was in the process of moving portfolios back towards benchmark allocations. This morning, I read an article in the Australian Fin Review from Chris Richardson from Deloitte Access Economics, and there's a couple of points there that I thought were very salient to mention today. In the article in the Fin Review today, he noted the following: it's eminently reasonable for the Treasury to expect a strong and sustained recovery. Over the past half century, Australia's growth, one, has accelerated the most in recovery from the recession in the 1980s. 2, the second fastest acceleration in growth followed the recession of the early 1990s. And 3rd, the 3rd fastest came after the Banana Republic crisis of 1986, the 4th fastest after the Asian crisis at the end of the 1990s, and the 5th fastest came after the global financial crisis in 2009. And I thought that was a very thoughtful summary. The global economic impact of COVID-19 is forecast to be 45 times more severe than the GFC. And as a consequence, I believe the recovery is likely to present a significant growth opportunity. Most importantly for you as clients, you don't want to be standing on the sidelines witnessing the recovery without participating in it. This afternoon, I'd like to acknowledge a couple of people particularly who've helped enable this presentation to occur. I'd like to thank Blair Modica, my account manager at BetaShares. Thank you very much, Blair, for supporting Orion Private Wealth Management and assisting greatly in facilitating such a high caliber presenter for today. Martin Craig from MJHC Legal, who I have a long association with. Raj Aniri from LPA Partners, great to see you both again on another presentation, and thank you for your ongoing support that you provide to the practice and the many joint clients that we work on together. Paul Griffiths from Centrepoint Alliance, who is my account manager there and does a great job in supporting my practice, and thank you, Paul, for all your support recent months. And of course, Zita, who is the behind the scenes person that pulls it all together and makes these webinars happen. So thank you to all of you. Just a few housekeeping points. Questions can be answered during the presentation through the Q&A button. We will address those at the end of the presentation, so we'll allow the presentation to occur and we'll allocate around about 10 to 15 minutes at the conclusion of the presentation. The video is being recorded and will be posted on the website, so if you want to watch the webinar, you will be able to do so. And a survey will be emailed to you after the presentation. It would be greatly appreciated if you could complete that. It does help us ensure that we provide the content that means the most to you. We have, as I mentioned before, two presenters today. Blair Modica is going to provide an overview of the exchange traded funds and the history and how they've developed, and also an outline of BetaShares. And most importantly is our special guest speaker, David from BetaShares. David Bassanese is the Chief Economist of BetaShares, and he's responsible for developing economic insights and portfolio construction strategies for advisors and retail clients. Prior to BetaShares, David was our economic columnist for the Australian Fin Review for over a decade. I'm sure I've read many of his articles over the years. Prior to the AFR, David spent several years in financial markets as a senior economist and interest rate strategist at Bankers Trust and Macquarie Bank. He started his career as a Commonwealth Treasury official, after which he spent 3 years as a research economist at the OECD in Paris. David is also the author of 2 online investment books. He graduated with first-class honours from the University of Adelaide and a Master of Public Policy from the JF Kennedy School of Government at Harvard University. And I think our Treasurer, Josh Frydenberg, also attended the same public policy qualification at Harvard a number of years ago as well. So you have something in common with our Federal Treasurer. So I'll hand over now to Blair. Thank you very much again, Blair, for making yourself available today. And look, we're all very much looking forward to your presentation.
Thanks, Ben. Pleasure to be here, and thanks very much for having us. It's always good to catch up. Known each other for quite a while now. So I guess for me, starting off today, I'll just give a little bit of an overview of BetaShares as a business and the ETF market for those that aren't too familiar with what an exchange traded fund is. And then I'll hand over to David, who's going to give a market and economic update and get into some of the nitty gritty on what's going on in the world at the moment. So quickly, just a very quick disclaimer, all information in this presentation is general in nature and doesn't constitute personal financial advice. But if we click over to the next slide, just some really quick information on BetaShares as a business. You may or may not know that we're the only Australian founded and managed ETF provider. And why that's interesting as an investor is probably twofold. So the first being that because all of our funds are Australian domiciled, there's no need for W8 Ben forms or any type of paperwork when investing overseas. So it's completely paperless in terms of the way you invest. And the second one that's interesting as well is because our funds team is based in Sydney, there's, I guess all the funds that we put together are created in Australia. So we're not badging anything from overseas like other managers may do and hope that it flies in Australia. It's all designed for the Australian practitioner and investor. So you can see there we've got the widest range of ETFs on the market at this point in time with 67. We just hit 13.5 billion under management as of last night. So look, we're really pleased to be in a growing part of the funds management industry, and I'm really excited about bringing more and more innovative solutions to our clients. Just want to jump to the next slide. And here what I wanted to show is just where BetaShares fits within the wider ETF environment in Australia. So you can see in 2019, number 2 for market share. And now 2020, we're pleased to say that we're number 1 in the space for market flows at around 32%. So a lot of people might not be aware that, you know, we're really, I guess, in the same regard as Vanguard and iShares, these types of businesses, but again, providing Australian-based funds for the Australian community. And in terms of the growth of the Australian ETF industry, you can see there that 45% growth per annum compound growth rate there. So up towards $70 billion in terms of funds under management and growing quite quickly. You can see obviously that sell-off in the earlier part of this year with the COVID crisis, but I guess really encouragingly what we've seen is a vast increase in the funds under management as the market's recovered, but also people again becoming more and more confident with the way ETFs work and knowing that they're robust in structure so that when an economic downturn and a market sell-off comes, they're more than ready to be able to handle that sort of volume that the trading happens in that environment. So you see there around 70 billion in terms of funds under management in Australia. And if we click to the next slide, what we can see is that really replicated over the global industry in terms of exchange traded funds. So you can see in 2005, quite a nascent industry in terms of assets under management, but we fast forward to today, Q2 of 2020, and over 6 trillion again in funds under management. You'll see that's a little bit down on 2019, but really that's to be expected with the sell-off that we saw in March of this year. And if we go back again to 2018, we saw something similar in December and January of that year, where the market sold off. So some strong recovery, but also strong growth over the past number of years. So ETFs really, they've been around for 30 or more years, but really have started to accelerate in terms of growth in the last 15 or so. So just to give you a really quick overview of what are exchange traded funds, I think it's good to take a step back and just consider what they are in the scheme of the funds management industry. And really, they're under the same rules and regulations as stipulated by ASIC as a managed fund would be. So we can think of them as a managed fund that's traded on the stock exchange. So in that sense, they're open-ended, which means they can be bought and sold at any time on market hours. As I said, they're exchange traded, which means you can access them online via your broker or financial advisor. And they typically employ rules-based strategies. And I'll touch on what that means in a little bit. But in general, the characteristics of an ETF are as follows. So generally they're low cost, and a lot of the time they take after passive type exposures. They're highly tax efficient. They're transparent. So if you log on to our website at any point in time, you're able to see the listing of what stocks we hold in each portfolio as of a daily occurrence. They're easy to access via online brokers. They're incredibly liquid, and I'm happy to touch on any liquidity questions you might have at the end. But I guess the main thing to consider there is you're as least liquid as the least liquid stock in your portfolio. So if you were buying an ASX 200 listed ETF, you really should have no concerns with respect to the liquidity of the fund. And of course, they enable great diversification. So you're able to buy, up to 1,000 or more different securities at any one time and have a great diversified asset. And look, we see it as an evolution in technology. So much as the telephone, a wire-based phone has now gone to the mobile, a book to an e-based Kindle, CDs to cloud-based Spotify, and computers which are becoming smaller and smaller. ETFs are just the next generation of the funds management industry that make it easier and I guess democratize the way we invest. So just looking at the exchange traded product evolution, and I guess a lot of people are familiar with ETFs in their index space. So whether that's the ASX 200, the NASDAQ or strategies like this, and certainly that was exchange traded product 1.0. So aiming to track an index weighted by their market capitalization or market size. And certainly we have funds available that do that. ETP 1.5 was aiming to track an index that's not weighted by market capitalization, but look at different metrics. And a good example of that's QOS that you can see there, which looks at companies based on their fundamental values. So sales, cash flow, book value and dividends, rather than their market capitalization. And there's certainly a lot of academic studies that sort of indicate that can perform better in different markets. ETP 2.0, so rules-based strategies, you can see there, BEAR, which is a short fund, GEAR, which is a geared fund on the ASX, and YMAX, which is a covered call strategy looking to, I guess, boost income over the Australian top 20. And then finally, ETP 3.0, which is incorporating actively managed portfolios into the ETF investment vehicle. You can see there, probably the main one that's been very successful over the last couple of years is our active hybrid fund. And it's worth considering. I think there's been a lot of debate over ETFs and active management and that debate over passive and active. At BetaShares, we really are agnostic on whether you're passive or active, but what we do feel is in some circumstances, certainly passive outperforms and can outperform active management over a long period of time. But in other sectors, such as the hybrid market, it certainly does or can pay to be or have an active tilt. And just to compare ETFs to other products on the market, and look, one of the key ones to look at is the difference between shares and ETF. And I guess the biggest part there is that risk diversification. So you're basically buying a basket of 100, 200, 300 different shares. So you're getting a diversified portfolio all in one trade. If we look at the differences between ETFs and managed funds, you can have a varying sense of liquidity within a managed fund, whereas ETFs, the liquidity is high. In terms of accessibility, ETFs are purchased like a share, so there are no minimums with respect to investing. We know with managed funds that's a little bit different and there can be minimum values to trade. And certainly with respect to the transparency of underlying portfolios, ETFs, you can see on the website at any one time what they're holding. Managed funds are a little bit more opaque. So that's it in terms of the BetaShares value proposition and ETFs in general. So I think we're going to do another poll now that Ben might jump in on, but then I'll pass over to David Bassanese, our Chief Economist, for a market update.
Yeah, thanks very much, Blair. We will just launch that next polling question, which is about your attitude to the outlook. All right, thanks, Zito. If you could close the poll and display the results. Okay, so we've got a bit of a mixture there on degrees of confidence. Confidence, at least at worst, there's some confidence. All right, thanks very much, Blair. If you'd like to hand over to David, that'd be great.
Thanks very much, guys.
Sorry. Yeah, thanks very much, David. I'll hand over to you then.
Yeah, no worries. Thanks, and great to be with you all. Very interesting times in financial markets. Certainly, my many years in the markets, probably the most eventful year I've ever witnessed. The thrills and spills of the equity market and then the economy. It's been quite a remarkable year. So I'm going to go through some of the situation with regard to the global economy, the Australian economy, and some of the financial market implications of all of that. Now, I just started a very high level. This is the global PMI index, and so what this is a summary of manufacturing and survey sector, sentiment indicators from businesses covering the whole world. So US, Europe, Asia, and as you can see. Basically, when that index is sort of in the 50 to 55 zone, it's sort of I call it the Goldilocks zone, where the global economy is basically growing along, not too hot, not too cold. When it's well below that, as we saw in the past two occasions, the GFC in early 2000, we're in recession. And, obviously when we're well above that, we've got a very strongly growing economy. So with that context, you can just see the sheer collapse in sentiment earlier this year with the economic lockdowns and COVID, having worked its way around the world, coming out of China and then to Europe and the United States. But the good news is that these PMI indices have bounced back somewhat. I mean, as you can see, they have bounced back all the way back into the so-called Goldilocks zone, as I call it. Now, the thing about these indices is they are basically what they do is they do measure business sentiment. And so when it's around 50, it basically says 50% of businesses say they're better off, well, conditions are better than they were in the previous month. They don't necessarily say they're, at a normal level, but they're just better relative to where they were. So even though these indices are back in this sort of 50 to 55 zone, the overall level of activity is still well down on where we were. So that's the reality. But at least things are getting better rather than getting worse. And that's more evident in the next slide, where I'm focusing on. This is a measure of global, aggregate weekly hours worked. And I've got the US and I've got Australia in there, and I've got percent decline from previous peaks. So these generally trend up over time. So when you get a pullback in aggregate hours worked, it means, unemployment's gone up. People have, been forced to, have lower average work hours on a weekly basis. So it's a good summary measure of activity, really, overall activity in the economy on a sort of rolling monthly basis. And what you can see there is the past recessions, and in the grey areas are US recessions. So the time in which US is defined as being in recession. And again, just to put it in historical context, the sheer collapse in activity over March and April, where aggregate hours worked dropped by around about 20% in the US and something like 10 or so percent in Australia, which is well beyond what we experienced in past recessions. We have had a bounce back. We've basically recouped largely half of that decline. And I've basically got the last few months blown up on the bottom slide there. So just because it's so switched up on the top chart. And as you can see, the overall activity did bottom around April with those lockdowns. And we've been recovering ever since. So that's pretty good news. I guess the one caution is that if you can see, the rate of rebound has slowed in the last few months. But I think it's still consistent with this broad recovery continuing, provided we don't go back into lockdowns, provided social distancing restrictions, don't get worse. They kind of gradually ease rather than get worse. And I'll touch on a little bit about COVID later, because I think there's been some important developments with regard to COVID just in the last few months. But that's the situation with regard to Australia and the US, and I think broadly that we are in this recovery zone. And again, if you think about it, the economic contraction that we've had was really collapsed within 2 months, March and April, and we've been recovering. So the level of activity is well down on where we were, but at least we're in this recovery phase at the moment. Now, if we just go to the next slide, I'll just touch on some aspects of the Australian economy in particular. And so this is consumer spending, income, and the savings rate. And as you can see, overall consumer spending has weakened. So the orange line, as you can see there, the annual rate of growth has slowed to about 0. What's interesting, if you look at the breakdown there, retail spending, so spending on goods has been really strong. So retail sales, funnily enough, despite there's some store closures and whatnot in the past few months, has been pretty strong because with the JobKeeper allowances, household income has actually held up pretty well, as you can see from the blue line there. And so people have been spending where they can. So you've seen car sales do quite well. Food sales, people working from home, shopping at so going and buying groceries for the home. But basically, broadly, consumer goods have been doing quite well. Services not so well. So obviously, travel, tourism, service-related businesses that have been the most shut down by COVID have been the sources of weakness. But overall, consumer spending has been weak, and a lot of that income hasn't been spent. So if you look at it, the savings rate, the ratio between income and the percent of income that households are getting that is not spent has gone up. And again, that bodes well for the economy going into, the next year, because there's a cushion of income that can be spent as the economy gradually reopens. Just on the next slide, looking at house prices, and again, if you read reports, there's been people talking about housing crashes, ad nauseum for decades, right? In Australia, we're constantly fearing a housing crash. And we've always said, the biggest risk for the economy is when unemployment surges, and that's when, you may get a lot of forced selling. Unemployment has surged in Australia, of course. It's up around about, 7-8%. But with the JobKeeper in place, and, a lot of people that are getting, increased unemployment benefits. You've had banks that have delayed, allowed people a repayment holiday. So there's been a number of measures in place that haven't caused a lot of forced selling in the housing market. And I think that's going to continue to broadly remain the case. I think house prices are soft. Obviously, you can see house prices have softened on an annual basis. They're actually still up on year-ago levels, which is quite remarkable. So overall, the past, since COVID struck, house prices nationally have eased back, I think is fair to say, rather than collapse, in Sydney and Melbourne in particular. And again, it just goes to the point that unless you get a lot of forced selling, a lot of people basically forced to sell at any price because, banks are calling in their loans, then you don't get a lot of downside pressure in the housing market. Also helping, of course, is that interest rates are at rock bottom levels. That sort of mortgage affordability is okay. Now, my outlook for house prices is, I don't see a house price boom anytime soon, but certainly next year, I think it could be, as the economy recovers, there'll be scope for house prices to start to recover. But certainly over the next, 3 to 6 months, they're probably going to remain flat to somewhat down, rather than collapsing. I think that's important. And again, I don't think the banks will allow. They're going to be cautious in forcing people to, there's going to come a point where people will be required to sort of start making repayments again, but it's going to be cautious in terms of how that is applied. In terms of housing activity, not so good. If you just go to the next slide. So that's house prices per se. The other element of the housing sector, of course, is home building. And this is just a chart of home building approvals. And as you can see, they've been weak. They've been coming off really even before the COVID crunch. And it's been the high-rise apartment boom, a building boom that was taking place across Sydney, Melbourne, and Brisbane in particular. Got a big surge in activity, which was coming off the boil even before COVID, and now with COVID plus the slowdown in immigration in Australia, and immigration has been a big fuel to housing construction, and that's slowed to a crawl. It's likely that housing construction is going to remain weak over the next year or so. So that is the sorts of activity won't be around. The other one. Just on the next slide is business investment. You can break that down into mining and non-mining, and the dot there is basically what surveys suggest investment's going to do over the next year. And as you can see, for non-mining, it's going to fall somewhat. Mining is actually picking up. So after a big decline for several years, mining investment is now starting to gradually start to rise. So mining service companies, are well placed in this environment where, after having cut back investment for a while, miners are starting to invest, if only to sort of maintain the mines and the activity that they've invested in the last few years. I should point out, one of the interesting things is that China has stimulated its economy quite well. It's come out of COVID pretty well. And it's voraciously continuing to demand iron ore in particular. So iron ore prices have held up. Our exports into China of iron ore have held up. So that certainly bodes well for the mining sector. But non-mining, the services elements of our economy, understandably, given COVID, their expectations for investment have been cut back. What we did see in the budget, of course, is there's been a big boost to investment incentives, and basically most major capital spending, up to a very high threshold, and for many companies can be instantly written off within a year. So The depreciation, the incentive to spend on capital goods, investment goods over the next year or so is quite high. So I think you may well see a turnaround in the business investment outlook over the next 3 to 6 months. Just going back to the situation with regard to the markets and what all this means for financial markets. I've got a chart there of the US overall global equity markets. It's the Wiltshire 5000, so it's just a broad measure of US equities, I should say, and the aggregate weekly hours worked measure that I showed earlier, and the grey areas there, recession. Just wanted to point out that if you look at it, the market tends to bottom ahead of the bottom in aggregate weekly hours worked. So when this broad measure of economic activity bottoms out, the markets kind of anticipate that to some degree. And you can see markets have put in a bottom before that happens. Now, on that basis, given it seems likely that aggregate hours worked did bottom way back in April, it's reasonable to say that downturn in the markets that we did get earlier this year was the bottom of the markets, because I think in terms of this, bear market cycle at least, because, I think the bottom is in for aggregate weekly hours worked. So we're not going to go back through those lows. And again, the path here is now one of recovery. We can debate the speed of that recovery, but the worst of it in terms of contraction is over. And again, another, I guess, an important difference between this economic downturn that we're going through and ones in the past is that I think with recessions in the past, they're gradual processes. The economy gradually weakens over 6 months to a year, possibly 18 months, as you can see by that extended period of weakness in aggregate hours worked in the US. And that's why bear markets can take a while as well. They can take up to a year before the market finally reaches a bottom, because it's taking a while for the economy to find a bottom. Whereas this time, the COVID crisis, the COVID crunch, whatever you want to call it, is so short and sharp. We basically had a collapse, but then a bottom. And so in that sense, the short, sharp correction in the equity market, is not that unreasonable when you see it in that context. So again, if you think that aggregate weekly hours work, if the economy has bottomed, it's a pretty good chance the equity market has bottomed. We're not going to go through those March lows. Now, we will obviously won't go up in a straight line. We're having a bit of a correction at the moment, particularly in the US market. But I think the trend from here is one of broadly, ongoing recovery, rather than we're still in this bear market and there's new lows to come. Just some other features of the market that I think are interesting. I mean, what's been helping the US equity market rebound of late, just to point out the increased retail participation. I mean, this was certainly a factor. This just shows a chart of the number of so-called Robinhood accounts that have been opening up in the US this year. So Robinhood accounts are it's a new way in which you can invest in shares. You can invest in shares on your mobile phone. There's no brokerage, because they basically sell the information on the number of people buying different companies. They sell that on to other financial groups that, hedge funds, for example, that kind of use that for their own trading. But the bottom line, it's a new way to invest. People have been sheltering at home, and you've seen a lot of people start to invest in the share market in the US. So increased retail participation has been a factor behind the markets, and particularly some of the hot names of late, the Teslas, the Amazons. There's been a lot of activity in buying up those individual names, and I think there's probably a little bit of short-term froth in some parts of the market in the US. But broadly, it's broadly, I think the economic justification for the markets having recovered still does make sense, although there are elements of froth, as I said, because of the retail participation. But the next slide I wanted to focus on, and this goes back to the COVID situation. And to me, this is the single most important development in the past couple of months. It's what's turned me personally, and certainly my investment, information and guidance, advice that I've been suggesting here at BetaShares with people that we talk to, from cautiously pessimistic to cautiously optimistic in terms of the market outlook and economic outlook. And this shows you a chart of the rates of COVID cases in various countries, along with the associated death rates. And as you can see, the first wave, and so again, going back 6 months when we first got COVID, and anyone who looked at the history book said, we've had pandemics in the past. We had the Spanish flu, we had the Asian flu, the Hong Kong flu, and they were typically associated with second waves of the virus. And so if we were going to get second waves, there was going to be a risk of a renewed economic lockdown. So although we did lock down, and then, you know, that helped flatten the curve, at least of the first wave, there was always that risk of getting a second wave and therefore potentially going back into lockdown. But as you can see, we have had those second waves as feared, particularly in Europe, but also in the United States. But we haven't had, you know, at least to date, and I think increasingly evidence is becoming clear, we're not likely to get the sort of death rates to the same extent that we were seeing earlier this year. And why is that? So a lot of the new cases we're seeing is because of better, more comprehensive testing. So and that is covering, you know, as again, you're getting a younger cohort of people being tested. Typically, the death rate, the serious infection rates amongst those is lower. And so the first wave really was people with very serious conditions fronting up at hospitals. And so the death rate and hospitalisation rate was a lot higher. So again, I think that what the bottom line to me is that means that we are going to be living with the virus. I mean, we're certainly, you know, still dealing with it. But the risk of renewed, you know, across the board lockdowns, and I am speaking to some people, you know, locking down in Melbourne at the moment. So I'm very conscious of that. But globally, the trend is that we're trying to learn to live with the virus and avoid going back into lockdown. There's been some outliers of that. Of course, Victoria and New Zealand to some extent have taken a very, you know, they did get a big spike in cases, and you know, rightly or wrongly, they did go into lockdown. But elsewhere at the moment, you know, countries are trying to avoid doing that, relying on face masks, relying on, you know, limited social distancing restrictions. But again, I think that's a very important shift in terms of COVID and how we're dealing with it, and possibly the economic outlook. The other feature, if you just go to the next slide, and this is very important. Again, if you think about what was happening before COVID, we had central banks where inflation was too low. And they were trying to get inflation up, and they'd cut interest rates to very low levels to try to, you know, boost inflation, which, you know, wasn't really working. Now with COVID and the economic slowdown that we've had because of it, they've cut those low rates to even lower levels. And not only that, they're now saying they're not going to raise interest rates for at least a year or two. If you look at the dashed lines in that first chart, are market expectations for short-term interest rates over the next year or so. And so if you look at it, the US, the markets aren't anticipating any tightening by the Federal Reserve for a couple of years, at least until 2023. And it's basically the same around the world, even in Australia. So these very low level of bond yields are likely to stay pretty low. I mean, they may, you know, bounce up a little bit with economic recovery over the coming year, but certainly stay well below the levels we've seen over the past few years. And again, so that's inflation low, unemployment still high, probably going to take a while before unemployment can get back to the levels that it was, means that the interest rate environment is going to remain, you know, very low. And again, for those relying on interest income, a challenging environment. So, you know, there's good and bad with that. If you do rely on interest income, you're being forced to you know, seek more creative ways of generating that income. For traditional ways through bank deposits and whatnot, is you know, it's going to be a very tough ask to try to generate income through that means. Just the situation with regard to the financial markets, I focus on the US here because the US is still the most important equity market in the world, and where the US goes, so does most of the world. So just a couple of points here on the US market. This is just a chart of the earnings outlook for the US, and the orange line is what's called forward earnings. It's a weighted, and the way it works is it's a weighted average of expected earnings for the current financial year and the next year. And analysts basically are constantly updating their expectations for earnings for companies. And as you can see, earnings expectations for 2020 and 21 were revised down significantly earlier this year. But the good news is that they've started to bottom out over the last few months. And And if that remains the case, if analysts don't revise down their earnings anymore, then forward earnings can actually they have started to rise and may continue to rise. So the way this mechanically works is that that orange line will touch that black line at the end of this year, because that will be expected earnings in 2021. And then it will touch that green line at the end of 2021, because that will be expected earnings as of for 2022. But the bottom line here is that earnings expectations were downgraded significantly. They've stabilised more recently, and markets are continuing to anticipate a nice rebound in earnings next year at this stage. Now, I've penciled in some numbers that are not as optimistic as current market expectations, but even if you allow for a bit more of a downgrade, it's still consistent with a broad recovery in earnings still unfolding over the next year. In terms of the valuations, the other big concern people have is with the valuations. Just on the next slide, and that is a chart of the US PE ratio and interest rates on the first first chart there. And the bottom line, the bottom part of that chart is the difference between the equity market's earnings yield. So that's the inverse of the PE ratio. If you take the price to earnings ratio, turn it upside down, you get the market's earnings yield. You take away the bond yield, and it's a relative measure of the equity market's, expensiveness or cheapness relative to, prevailing interest rates. As you can see, first and foremost, the PE ratio is high. So in the US now, it's around about just over 20 times earnings at a level we haven't seen for 20 years. So the last time the PE ratio for the S&P 500 was anywhere near 20, it was back in 99, 2000. But as you can see, the big difference is that interest rates are a lot lower than where they were 20 years ago. And if you look at that earnings, so the difference between the two, the risk premium, if you like, the equity risk premium, it's at the lower end of its range of the past decade, but it's still comfortably above its longer run average, and certainly comfortably above where it was during the dot-com bubble. So again, if you hear stories about, valuations are back at dot-com bubble levels of 99, 2000, that's just looking at the PE ratio. It's not factoring in the fact that interest rates are so much lower. And another way to look at that is if you look at on the next chart is the next Y dot, just stay with that first chart, just the price to earnings ratio vis-a-vis interest rates. And as you can see, broadly over time, we've had a trend up in the PE ratio as we've had a trend decline in interest rates. And as of September, with bond yields in the US sub 1%, the 10-year bond yield about 0.7%, broadly, a PE ratio of around about 20 is arguably not that unreasonable. So we are where we are basically because of quite low interest rates. Just to touch on the US election, I guess one near-term risk factor for markets will be the US election. Might just speed through a couple of these slides in the interest of time, but just the first one shows that typically the US equity market does tend to be cautious. Well, historically, going back over 100 years, analysts have done this assessment that the markets tend to be weak in the lead up to a US election and then bounce back in the months thereafter. I've got more recent history here, and as you can see, on average, the markets haven't done that badly, in the lead up to US presidential elections. The two big exceptions, the two big exceptions were 2000 and 2008, and that's what I wanted to touch on. If we just go to the next slide there, and I guess the risk for this year for the equity market is that a rerun of either or the 2000 and 2008 scenario. So in 2000, again, it was the contested election, Gore versus Bush. There was a debate about the validity of some votes. They went to a court challenge. We weren't sure of who the president was going to be for a few weeks. Eventually, Al Gore conceded. George Bush became president. But there is a risk of now with the postal votes being so significant in the US that some of those votes could be challenged if it's a close result, particularly, if Trump loses in a close result, he is threatening to mount court challenges and question the validity of those votes. And the other scenario is 2008, where was a new president elected, the economy was weak, the markets were looking for some fiscal stimulus, but because of the new president, he really couldn't deliver that stimulus till he was sworn into office early in the new year. And it was only when we got that stimulus, the markets bottomed, finally bottomed in early 2009 with the last great US stimulus package of the GFC. And now, so if Biden were to win and there's no stimulus done, and they're still talking about possibly stimulus is on again, off again in the US at the moment. Donald Trump sort of killed hopes of stimulus a couple of days ago, but overnight there's talk of possible smaller packages getting through. But if there's nothing done between the election and then Biden wins, then we may have a period where, you know, nothing gets done until early next year. So that is a risk. But what I would say, the markets seem to be pretty upbeat in the sense that they, as long as they're pretty confident a stimulus package is coming, I think, you know, they may continue to trade on the basis, well, it's coming. You know, it's better, you know, as long as it's coming, then that's a good thing. And I think whoever wins, there will be a stimulus package, another big stimulus package in the US. I think that's pretty clear. In terms of the polling, Biden is still favourite to win. I mean, I think with the debates, it's stretched out a little bit even more. I guess the one proviso, of course, is that, you know, the polling suggested Hillary Clinton was a very high chance of winning 4 years ago, and obviously the polls got it dead wrong. So you've got to take these with a little bit of a grain of salt. But nonetheless, at the moment, the polling suggests a fairly good chance of a Biden victory. The other thing to watch out for in the election, of course, just on the next slide, is not only who wins the presidency, but who gains control of the Senate. And at the moment, the polls suggest the Democrats are a reasonable chance to take control of the Senate from the Republicans. And so that way you could get this blue sweep, Biden in office and the Democrats controlling the Senate, in which case, you know, it does open up for, you know, things like tax increases, corporate tax increases, regulation, you know, greater regulation of the tech sector, these sort of things. So there is a risk, again, if the Biden wins and the Democrats win control of the Senate, that at least initially there's a bit of a you know, knee-jerk negative reaction to what they may do in the Senate. And you certainly can't rule out you know, those sort of measures. So just to summarise on the final slide, not on the final slide, but in terms of the election, the positives for Biden, the negative for Biden, of course, is the risk of corporate tax increases. The positive is that he'll probably be a less erratic president. He won't be tweeting every day. And, you know, I think the markets will, you know, like that. Trump, I guess the concern is that the positive of Trump, of course, is that he will preserve those corporate tax cuts and may well seek to cut taxes even further. So from a market's point of view, at least, political judgments aside, from a market's point of view, at least, that's what they would like. So, you know, Trump, from a market's point of view, is being perceived as more market friendly because of that bias toward cutting rates. Just got a couple of slides to conclude with. Firstly, this is just my global equity scorecard. And what I've got there is the performances of equities around the world, broken by region, by global sector, and by factor. And again, there's whole different ways of investing, as Blair touched on, you know, investing in global markets these days. You can invest, you know, you can obviously buy an ETF that tracks the whole global market, or you can invest in specific regions or specific sectors, or even by specific factors, like things like quality, value, growth, these sort of issues. But just in terms of the situation at the moment, yes, you can see the thematic up until COVID was the US outperforming and things like growth areas such as technology outperforming. And with the COVID, what's been remarkable, or not remarkable, but I guess fortuitous for those sectors, is that they were the growth sectors before COVID, and then they turned into defensive sectors during COVID because with the lockdowns, the sort of tech companies, you know, people staying from home, using the internet more frequently, they were, you know, seen as defensive sectors. So they shifted from structural growth stories to defensive sectors, which was, you know, so they've actually, you know, continued to do relatively well. Now, coming out of COVID, I think they may well continue to do quite well because that structural growth story supporting, you know, the NASDAQ index, for example, the FANG stocks, you know, the Googles, the Amazons, the Facebooks, will continue I think will start to reassert itself. So my hunch is that sort of growth technology thematic will basically reassert itself as the key sort of you know, source of outperformance within global markets as we head into 2021. Just to conclude on the Australian market, and I've just got it's a busy chart here, and but the bottom line, what it tries to do is analyse how our markets perform vis-a-vis global markets and some of the reasons. And you can see, if you look at just the last 6 months, the global market's up about 30%, nice bounce back. Our market's up, but it's only up about 15%. And if you go through the reasons for that, you can basically break it down into, it's either because this is called a shift share analysis, so I won't go into the details, but basically you can break down why we're underperforming or outperforming by our sector composition. Are we in the right sectors, or are the sectors that we have not doing as well as the sectors globally? And the bottom line here is that we've struggled because our financial sector has underperformed global financials. So our banking sector has really been struggling with the slowdown. But not only that, the financial sector globally has been struggling, and we are overweight financials, so that doesn't help our market. The other key thing is that technology, as I pointed out, the global technology sector has been doing very, very well. Our sector, technology, has been doing quite well, but unfortunately it's a smaller weight in our market. So that's been a drag on our market as well. So bottom line is that our sector composition, underweight technology, overweight value parts of the market, such as financials, haven't been helping our market. And I think going forward, that is going to be the struggle for our market as well. If technology remains a dominant global thematic, that's going to be a source of a potential underperformance of our market vis-a-vis global markets. I think I'll leave it there, and hopefully we've got some time for questions.
Thank you very much, David, and also Blair. Thank you very much, yep. David. The presentation was very comprehensive, and thank you for taking the time to step through those slides. Often clients don't get the opportunity to hear an explanation of how views are formed at a macro level, and your explanation detailing both what's happened and the outlook, I'm sure has given clients a lot of confidence and reassurance about where we're heading from here. Just a couple of points I'd like to summarise before we do go into questions, and we've received some questions from clients, which is terrific. As some of you may know, my dad was a stockbroker, and I remember very early on when I started working, I asked him how he identified stocks to invest in and what were the leading indicators that he really relied on. And one of the leading indicators that he said stood the test of time and was very reliable was companies' earnings growth. So when he saw that companies' earnings growth was occurring, he believed that would reflect in the stock market or in stock price in around about the 6 months time frame. And certainly we're starting to see the beginnings of that, and that should give investors some reassurance. The other factor that I think is very important to remember is that an enormous amount of stimulus has been injected into the economy, with more to come. Certainly, the Treasurer on Tuesday night reiterated the fact that this is the highest level of debt Australia has seen since World War II. From when those decisions are made, it takes some time before it gets absorbed into the economy, and then the benefits get felt and the share market follows. And that lag is generally around about 3 to 6 months in itself. So I think the conclusions from those two comments is that you don't want to sit on the sidelines and be getting into opportunities after they've already had their benefit. You want to try to identify them early so you can get in early. And certainly there are some good sound reasons why we're seeing the indicators that there'll be growth over the next 12 to 24 months. The final point that I would raise, and certainly David touched on it very, very well in his presentation, is what's the alternative? If you're not invested into the growth market in some description, you're going to be investing in effectively cash fixed interest. And certainly the outlook for that is to remain very unattractive for the foreseeable future, next 2 years or so. There is an expectation that Australia will cut its interest rates so that they're at 0.1, with that cut likely to be announced in November in the lead up to the Christmas period, but possibly in December. So holding cash, unless you are very pessimistic about the outlook, isn't really an attractive option. So I think at the moment it's very appropriate for clients to be moving back towards benchmark and perhaps tilting their allocation a little bit further towards growth orientation. Just before we take have the questions, and I encourage you to use this time, please, to if you want to add any submit any questions, use the Q&A box at the bottom of the your screen. We'll just last poll has 2 questions. So Zita, if you could submit or put those up, please. And it just looks at firstly what your intention is for the next 3 months, and what if you are looking to invest, what sector of growth assets would be of interest to you. All right, Zita, we might close that. Thank you. Okay, a good spread of interest in investing across a number of sectors there. Thanks very much. David, the first question I've got is one that you touched on very briefly, which was the iron ore price. A client has asked, is the iron ore price likely to be sustained? And they must be a well-read client. They've asked about the Brazilian supply to iron ore and how long it will be before that resumes normality.
Yeah, look, good question. Look, I think the Brazilian supply, my understanding is it is you know, coming back on stream pretty well. So the Brazilian, you know, supply, it was obviously disrupted earlier this year with the COVID, you know, going through Brazil in a pretty bad way. But supply, you know, I think it is coming back. It will come back somewhat more. But I mean, the biggest story here is not so much supply disruption, it's just the sheer ongoing demand out of China. China almost did a rerun of the GFC, whereby if you think back to the GFC, they were hurt pretty badly, but they flicked the switch to a lot of top-down infrastructure programs and really helped boost their economy, which in turn boosted our resources sector and the iron ore price. And we've seen the same thing this year. And in a way, whereas a lot of, you know, I guess Western economies, Australia, the US, Europe, we rely on consumer spending. We give a lot of income to households. In China, they rely on sort of top-down industrial production to drive their growth rebound. You know, encouraging local governments to invest in infrastructure programs, engaging their own programs and housing construction and whatnot, which is quite steel intensive. So that's been, to my mind, the main driver. So, well, you know, so I think iron ore, you know, probably can hold up at pretty, you know, attractive levels. I mean, it did get over $100 a tonne. The government's had a forecast for a while that it will fall back somewhat. It had a previous forecast of as low as $50 a tonne. I think that's been upgraded somewhat. But look, I think it's going to stay, you know, at a pretty good level without, you know, it can bounce around. But I mean, I'm pretty, you know, optimistic on the iron ore front, really, just because the bottom line is China needs our iron ore, and it's still, you know, voraciously demanding it.
Thanks, David. And I think also there's an important side message there, and that is that it's very good that Australia, in terms of trade, the Australian government gets a lot of revenue from all that sale as well. So for those that are concerned about the levels of debt, I think the government's certainly factoring in the fact that, factoring in that there are low interest rates, so its borrowing cost for that money is low, and also that there'll be strength in the mining sector, which will generate some good tax revenues for the government. As I mentioned in my opening remarks, I have been asked a lot about gold stocks, David, and I know you touched on it, but wondering if you could give an overview of your outlook, and perhaps Blair, you might touch on investment options for getting exposure to gold.
Yeah, look, gold's an interesting one. I very briefly did touch on. Look, gold's had a great run, and if you look at it, gold, the big driver of gold, I think, over recent years has been interest rates, and so gold has basically been rising since about late 2018, when the Federal Reserve moved from raising interest rates to sort of signalling it's on hold, and then it started cutting interest rates through 2019. And obviously with COVID and central banks cutting rates a lot more, it's really helped push along gold. And what we're seeing is that many bonds around the world are now trading at negative interest rates. And so so to have a sort of an alternative safe haven from traditional bonds, people are looking at gold and holding some gold. And so it's really, I think it's that interest rate story that's driving the gold price. I think interest rates, as mentioned, are going to stay very low. So I think the gold price can probably stay relatively elevated as a result, as people continue to use gold. And again, if you get more quantitative easing from central banks, if the Federal Reserve feels the need to do even more stimulus, and it may want to do that because I think it's going to struggle to get inflation up, then gold may get another kick along as well. Well, I'm not super bullish on gold, I must, to be honest, on a long-term basis based on inflation. So I think gold is a good story, but I don't rely on inflation breaking out to do it. Some people like gold because they see inflation starting to take off again. I don't see that. I think inflation is going to stay low for structural reasons. But as a result, interest rates will also stay low. And so that's the thing that I think will continue to support gold prices going forward.
And Blair, do you want to touch on those that may be interested in gold? What options are available with BetaShares?
Absolutely. So there's a couple of options. The first and probably the most sensible one is our QAU fund, which is a gold bullion exposure. So essentially, we are holding the gold bars in a bank account in London and putting forward a fund for you to invest in. Now, there's a couple of interesting things about the fund itself. It's the only fund on the market with currency hedging. And for some of the reasons David went through, it does pay to be currency hedged when gold performs, just the way the Australian dollar can rally. So it's currency hedged. And with that, you then get a tax ruling on the product, which means that you're potentially eligible for a CGT discount. So there's one option that's available. And then the second one would be MNRS, which is a global gold miners fund focusing on individual companies. Now, this acts as a more leveraged play to the gold price, whereas QAU will just give you the spot price of gold. So there will be more volatility involved in purchasing MNRS, which is an exposure to a variety of different gold mining companies.
Thanks very much, Blair. And the final question to you, David. As a chief economist, where would you be allocating cash if you're coming out of the market at the moment? Which sectors are most appealing to you?
Yeah, look, I think I go back to sort of that thematic of technology, and technology just doesn't involve, the FANG stocks or the Googles, the Amazons and Facebooks. I mean, if you look around the world, the Asian technology sector, is doing very well as well. The Asian region is even more advanced than the West in terms of using technology, mobile phone payments and whatnot. So I just think the growth thematic of information technology, and so again, like in terms of, just different areas, there's cybersecurity is a technology thematic. I think for obvious reasons, that is booming because people just need more and more protection against the various hacking that's going on now around the world. Robotics and artificial intelligence is another great technology thematic. Population aging, more and more manufacturing, and not only manufacturing, a lot of other activities are using robots and artificial intelligence in place of labour. And so again, that's another very great, longer term growth thematic outside of just necessarily the FANG stocks. But of course, the Googles, the Amazons and Facebooks are going to continue to do well as well. So, and you can get exposure to that through, say, the NASDAQ, ETF. So we have different, again, in terms of BetaShares, we have different tech thematics in all of those areas: robotics, cybersecurity, the NASDAQ, and even Asian technology funds. So I put my money on growth. The other people like to talk about growth versus value and sort of the rotation into value. If you look at what is value, value is financials and energy companies in large part. They sort of are big parts of that part of the market. Financials are under pressure because low bond yields hurt their margins. So it's difficult for financials to outperform in a big way in a low bond yield environment. And energy companies, because of the weakness of oil prices and the structural changes going on in the energy market, are challenged also. So that value, although, people like to talk about growth versus value rotation, when you think about the sectors underpinning it, it's technology versus financials and energy. And at this stage, you've got to, I'd be backing the technology sector. So that's probably my answer there.
Terrific. I notice it hasn't received a lot of press, but the Australian government has allocated $1.35 billion over the next 10 years that was announced in this budget to fight cybersecurity or have cybersecurity capability. No doubt they'll even be spending more over that time, but it's a huge amount of money, and certainly indicates very clearly that it's going to be a concern for a long time. And obviously the government, while it may have some capability, does look to private providers like other areas of defence to provide that support that is required. And of course, that's not unique to Australia. It's consistent with what's occurring overseas. They're all the questions I've received. Blair, did you just want to wrap up with anything, and particularly with anything that David just mentioned about technology?
Yeah, look, Ben, absolutely happy to touch on that. In terms of our technology suite, it's quite comprehensive. So there's NDQ, which focuses on the top NASDAQ 100 stocks. Asia, ASIA, the ticker code, focuses on the Asian technology tigers. Around 50% of that fund's based in China, but the rest of it is excluding Japan. So you get a lot of South Korea, Taiwan, a little bit of Thailand and India in there as well. That's performed very, very strongly. And look, the other one to consider just from a broad-based point of view, if you were bullish on the tech sector in Australia, is ATEC, ATEC, which is a Australian technology index that was launched in March of this year. And there's quite some excitement with respect to the growing amount of Australian technology companies led by Afterpay, Xero, and I guess the buy now, pay later sector as well. So that's quite exciting too. So, please reach out if there's any further information on that. But from our point of view, Ben, and everyone that joined, thank you very much for tuning in and certainly for your time.
Terrific. Thanks again, Blair, for your ongoing support to Orion. It's very greatly appreciated. You've given terrific support, and look forward to that continuing in the future. I'm sure there'll be some follow-up inquiries from clients, and we'll be in touch again very shortly. For the clients, thank you very much for attending the presentation. It will be appreciated if you could take just a couple of minutes to complete that. And we are in the process of organising reviews at the moment. However, if something particularly is sparked an interest for you and you wish to make contact before we contact you, please don't hesitate to reach out at any time. Thank you very much, and I'll close the presentation. Thanks again.
Thanks.
Bye-bye.